Hello everyone, welcome back. Have you ever noticed how the market seems to repeat the same shapes over and over again? Triangles, flags, head and shoulders? These aren't random. They are patterns that reflect what traders are doing. But here's the problem. Most traders can recognize the patterns, but they don't actually know how to trade them. They either enter too early or get caught in fake breakouts. So in this video, I'll show you what these patterns really mean, how to trade them, the textbook style and my style, how to avoid traps, and how to combine them with confluence. Let's get into it. Chart patterns are simply repeating structures formed by price action. They reflect market psychology, fear, greed, accumulation, and distribution. They are not magic, they don't predict the future. But they help you understand what the market is doing, what phase it's in, and what is likely to happen next. So we have two main types: the continuation patterns, like flags and triangles, and the reversal patterns, like head and shoulders and double tops and bottoms. Let's start with triangles. Triangles represent compression. Price forms lower highs and higher lows. This creates a tightening structure. What does it mean? It means that the market is building pressure. Buyers and sellers are both active, but neither side is winning yet. Eventually, price breaks out. So we have three types: ascending triangle for bullish bias, descending triangle for bearish bias, and symmetrical, which can break either way. Now, triangles are known for fake breakouts. It is very common to see a breakout in one direction followed by a sharp move in the opposite direction. Inside the triangle, liquidity is building on both sides. Above the highs, we have buy stops. Below the lows, we have sell stops. So what does the market do? It often breaks one side, triggers traders, takes liquidity, and then reverses into the real move. This is how a fake out looks like. Price breaks above resistance, traders enter long, with no follow-through, and price drops back inside the triangle. That breakout just became a trap. Same happens on the downside. But how to avoid getting trapped? You wait for confirmation. You look for a strong impulse outside the triangle. You also look for increase in volume. For example, here, the volume is relatively the same on the breakout candles as are on the previous candles. Price cannot hold outside and then comes back inside the triangle and closes here, and then moves in the other direction. On this breakout here, we can see that the volume increased compared to the previous candles. And also, price holds outside the triangle and it doesn't come back in. But even if you follow all these textbook rules, there's something important I want to mention. Personally, I don't like trading breakouts. Not because they never work, but because they are one of the most manipulated and inconsistent setups in the market. Instead, I prefer to let the breakout happen, see how price reacts, and then look for confluence to form a bias. For example, I wait for structure alignment. In our example here, price was in a downtrend, so why would I want to predict a reversal where price is compressing? I wait for a Fibonacci level. Since price is doing lower highs, using Fib retracement, I can see where my resistance is. And I can also use a volume profile for further confirmation. And as we can see in our example here, price stopped perfectly on value area high of the triangle and 786 of the Fibonacci. So this way I don't get caught in a fake out. I wait for price to show me intention. So my rule when it comes to triangles is don't predict, react with confluence. Second pattern, flags. Flags are continuation patterns. They form after a strong move. Then price pauses in a small channel. As a structure, they look like this: impulse, small pullback in a channel, and breakout. And that means the market is taking a break, absorbing orders, and preparing for continuation. If you follow the textbook, you can trade the flag by identifying the strong impulse first and entering on the breakout in trend direction. But as I said, I don't trade breakouts. So let's see a different approach. Think of it as something you already know. Instead of chasing the breakout of the flag, you take the safer trade, the pullback setup. You wait for the market to show you direction. Then you look for confluence, VWAP, Fibonacci, structure, or volume. And we have a pretty nice example here. Let's see. We have the impulse move. Then we have our channel, our flag. Price breaks out of the channel, but we don't chase the breakout. We wait for a pullback. And for that pullback, we use Fib retracement from the swing high to the low that caused the market structure break. And we use a volume profile to see where most of the activity happened. We can also add an anchor VWAP from the swing high. And this is how we get our confluence zone around golden pocket and 707 inside the Fib retracement. This is our short entry, not chasing the candles of the breakout. This is a daily chart. If you want to have a tighter risk reward, you can go on a lower time frame and find a lower time frame market structure break and get an even tighter risk reward by entering on a 5 or 50 minute market structure break and having the stop loss above the last high. From here, looking for lower targets, we use a Fib extension from the high to the low that break the market structure and to the high of the pullback, and we get a perfectly 1618 take profit target. So my rule for flags is don't trade the pattern. Trade the pullback after the market have shown you intent. Pattern number 3, head and shoulders. This is also a reversal pattern, and it signals that the trend is losing strength and may be preparing to change direction. As a structure, it looks like this. It has a left shoulder, first push up, then a pullback. Then it has a head, the higher high, then another pullback, and the right shoulder, a lower high. And the most important, the neckline, which is the support level. What's really happening here? This pattern shows a shift in control. The left shoulder shows us that buyers push price up. Then they take profits and we get the pullback, which is a normal behavior in an uptrend. Then we have the head, where buyers push price again, makes a higher high, takes the liquidity above the left shoulder, but then price drops again, which tells us this is just a swing failure pattern and a liquidity grab. Price action is still bullish, but it's starting to weaken. And that is confirmed when we have our right shoulder here, where buyers try to push price higher one more time, but they fail to make a new high. And this is key. This shows us that buyers are losing strength and sellers are stepping in earlier. The neckline is the most important part. It represents the level where buyers were previously holding the market up. When price breaks the neckline, it tells us that support becomes resistance and control moves to sellers. Now, the common approach to trade it is wait for the neckline to break, look for momentum and enter in the new direction. But as all patterns, this one also can fail. For example, price breaks below the neckline, it has a quick rejection and a strong candle back above, followed by a continuation upward, and this becomes a trap, which often leads to a strong move in the opposite direction. The second type of head and shoulder is the inverse one, which is the same idea but flipped. We have the left shoulder, we have the head, and then we have the right shoulder where sellers cannot push price lower to make a new low. And from here, the break of the neckline gives us the breakout. Now, how to trade it without chasing the breakout? You wait for a break of neckline, a pullback into a level of confluence, and you wait for a confirmation entry. Let's see an example. We have the pattern here. We have left shoulder, we have head, we have right shoulder, and the neckline. As you can see, price breaks out, takes the high, but it simply does a swing failure pattern of the most recent swing high. So instead of chasing the breakout here, we wait for the market to show us intent. And that means price goes down a little, doesn't break the market structure here, goes up again, prints a new swing failure pattern of the last high, and then on the way down, it does a market structure break here. This is our confirmation that the market has changed structure. And from here, we wait for a pullback. In order to find our confluence zone for entering a short, we use the same tools. A Fib retracement from the swing high to the low that breaks the market structure, a volume profile, again from the swing high to the last low, and an anchor VWAP on the swing high. And this is how we get the same area of confluence around golden pocket and value area high. This will be our entry short. For targets, as we discussed in the Fib video, we use a Fib extension from the high to the low that break the market structure and to the high of the pullback. And this is how we get our take profit at 1618. So my rule when it comes to head and shoulders is it's not about the pattern, it's about the shift in structure. It gives you the confirmation that the market has changed structure. And from there you can use your confluence tools to find entries for the opposite direction trades. So for me, patterns alone are not enough. A triangle, a flag, or a head and shoulder is just a visual formation. But a formation without context has no real edge. That's why I combine patterns with my system. Structure for direction, liquidity for targets, volume for confirmation, and VWAP and Fibs for entries. So instead of asking, is this a triangle? I'm asking myself, where is this triangle forming and what does it align with? Because the same pattern can give you a winning trade or a losing trade, depending on context. So how each tool adds value to our system. Structure for direction. This is your filter. In an uptrend, you look for longs. In a downtrend, you look for shorts. Patterns should follow structure, not fight it. Liquidity is used for targets. Equal highs or lows, range highs or lows, stops above or below structure. This tells you where price is likely to go. Then we use volume for confirmation. If we have a breakout with strong volume, that means we have participation. If we have a breakout with weak volume, that means it has a higher chance of fake out. So volume answers the question, is this move supported? And then we use VWAP and Fibonacci for entry zones. Instead of chasing, we wait for a pullback into confluence, and this is how we refine our execution. This gives us better entries and risk control. So what we've done here is flip the mindset. Most traders see a pattern and enter. Our approach is you see the pattern, you check context, you wait for confirmation, and then you enter. So my main rule when it comes to patterns is don't trade the pattern, trade the confluence. I know this is not the approach most traders apply when it comes to patterns, but this one is what works for me and I hope it will work for you too. In my opinion, chart patterns are not a strategy by themselves. But when you combine them with everything we've learned, structure, liquidity, volume, VWAP and Fibonacci, you can use them to understand how the market is preparing to move and help you plan your next area of confluence for a trade. I hope you'll find useful my approach. Let me know in the comments what do you think about it. In the next video, we'll give the final touch to our strategies and talk about risk management, position sizing and consistency. Until then, take care. I'll see you in the next one. Bye bye.